Hello, this is Cryptolyze. I hope you are well. This Saturday, 21, October 2023, it is with pleasure that I meet you today to talk crypto, to talk BTC, but also to talk macro. It will be important. We had a lot of news that arrived today. This week, whether with Powell, whether with the ETFs, I think it is important to take stock to know exactly where we stand, particularly in the different strategies. In any case, hypothesis that you formulated. We're going to take stock of the whole thing because I'm still asking myself a lot of questions, and you'll see it's going to be very interesting. As a reminder, you always have the possibility of having free access to the educational course, which is a 60-hour training worth €400, which allows you to learn blockchain, crypto, investment, analysis technique, trading, everything to become profitable. Through 130 videos, 400 pages of guides, quizzes to find out where you are in your progress, and all for free. To have access to this lifelong training, simply use the platform of one of our partners. Everything is explained in the comments and descriptions. We start with the notable event of this week, which was Jerome Powell's speech on October 19. So he used the term surprised at the resilience of the U.S. economy, how well the U.S. economy was holding up despite the rate increase. And this term surprised, precisely, we surprised more than one, and it was the reaction that was strong from the market that also explains why we broke bearish. So there are other things that come into account. The fact of having an American economy which is holding up despite the increase in rates also implies that the Fed could be led to increase its rates once again or to hold its rates even longer. And there obviously the market reacted badly because we have tensions on long rates. We will see that later. And which in fact quite simply make it difficult to refinance the American economy. And obviously we have a certain fear that is being made. And that is why this speech has something so special because, as I told you for some time, for me the target for a long time was 5-5 at the level of Fed rates. We have arrived. I said that he was not going to increase the rates for me despite the allegations he had made during the September meeting. This is what he confirmed there. The rates are not going to increase. We are going to wait because that he also doesn't need to raise rates. Why doesn't he need it? Because we already have a very strong increase in rates taking place, and we see it here in this graph, which are no longer the key rates really of the Fed, but which are the rates of the U.S. 2-year bonds, 10 years, 5 years, and 30 years, which really give us these four curves there, and we see that they are going up on their own. They do not need to have an increase in the rates of the party to continue to increase, and so that means that we have here a reduction in the valuation of the liquidity present in the world economy because we are talking about the economy in dollars, and this is the price of refinancing the American economy. And it all started from this speech and the increase in these rates. In fact, it is the combination of the two that leads to something complicated in the American economy. Because that implies that we no longer need to have an increase in rates to have an increase in uncertainty in the American economy. And this is what we see in terms of the increase in this yielding, therefore, which is the payment, in fact, of these American rates. And we must understand that there is a strong correlation between the price of the American bond, therefore bounds, that is to say the American Treasury bond, and the rate, which is the more we have a rate which rises, the more the price of the bonds and the cents, okay? It's a relationship that is inverted, and this is clearly visible at the TTL level. This is a graph that I have shown you for a very long time, and which is here an ETF on American Treasury bonds 20 years, and over therefore which is made by BlackRock, which allows us to have in fact general visibility. And we can clearly see this stall since April 2020. And this really very strong acceleration in 2022, which has taken place. First acceleration, second acceleration, and we see that we are reaching lows, and we are in the process of go get the $80, and there we really have this level, which is for me when we have a rupture of the 80, it is the rupture of this low. There it is really in fact the catastrophic point in the sense that we risk really having a rupture, whether at the level of the funds of pension, whether at the level of the banks, because we must understand that here, as long as the American bonds are not sold, the loss is not cashed. But if we ever have a bank run, as we were able to know at the level of certain banks, this implies that it will be necessary. Sell assets so they can pay people and people can get their banks back. So on this, I'm not going to come back to the banking system in which banks have an obligation to have what is called a reserve rate, and therefore a liquidity rate to be able to ensure withdrawals and therefore behind assets. But there, if we have a real bank run, we risk having a sale of the assets which will be carried out and therefore a cash out of the losses of agreement. So this implies that people will have to, people meaning entities, therefore funds and banks, will have to sell assets which are at a loss and therefore absorb losses which are not yet noted in their balance sheet. And that's where we risk having a cascade of liquidity and liquidation at the level of the different entities, pension funds, whether it's also banks, American, and that's where it's going to be really very complicated. We see that we are really getting closer, strongly. And there we will have to see whether the Fed will take action as it has already carried out with SVB and the other banks. So the loans they have made on the different assets, see whether they will put back the same thing. Is this something that they have already anticipated or not? But in any case, for me it is we are arriving in the crisis zone, and the fact of having this increase here in terms of yielding, it also implies that we have a strong fear of American bonds. So, implied a fear around the asset which is the least risky, considered to be the least risky in the world, because we have a political uncertainty which is also strengthening with what is happening in the Middle East and the Ukraine war. So we have a real tension that is occurring, and this tension leads to tension in the economy. This is why the Fed does not need to raise rates, because rates rise on their own because there is uncertainty. And so that means that there is a refinancing difficulty which will also be at the level of the American economy, and of course at the level of the world economy. So on this, I also ask myself the question, because the rates, would they not have been higher if there had not also been tensions in the Middle East? That is to say, when we have tension phenomena, what happens? People will move towards the least risky assets, meaning gold and American bonds, and reduce the risk vectors that can be found on the stock market, and even the ultra-risky crypto market. We'll keep that aside, we'll come back to it. You'll understand why, because it's really interesting. But so we have this approach where if we hadn't had that, and we hadn't had this transfer of liquidity at the level of risky assets to non-risky assets, wouldn't we already be a little upper? Wouldn't we already be in the 5 or the 6 here? And what would happen precisely if we had certainty at the level of the American government, because that we have a problem arriving in November that has been postponed to the fact that we will have to define the American budget. So that is something else again, and inevitably it adds uncertainty. So we have a real tension which is occurring, a tension which is increased by oil here because we are in conflicts at the level of the Middle East, with a risk at the level of Iran in which we could have the channel of global supply of oil to the whole world, which could be blocked, which could have tensions around it, and therefore necessarily real inflation pushed by what? By oil. And this is really the box that I am telling you, if we break the 93, it means that we are going to retest higher. We are going to retest the 120 and clearly more than 90. It's really complicated whether for Europe or for the USA, in which we will find ourselves with supply difficulties, with a structural increase of inflation, because oil is not just gasoline. It is the production costs of a lot of companies, the import costs, the export costs, and therefore we will find ourselves on an inflation which will increase while we have high rates, and therefore an impossibility of being able to reduce rates here to revitalize the economy, and therefore find ourselves in a phenomenon that we absolutely do not want. High inflation, sharp increase in rates, and therefore impossibility of having growth because we have inflation and because we have high rates, and therefore here we really find ourselves in something which is very complicated to manage. And that is why we will have to monitor the economy, in which here we had a reaction, which is really bad this week. We closed the S&P 500. We see that we are closing below the previous wick. So we are really validating my objective of 4,100. And here I'm trying to say to myself, yes or no, we are going to arrive at this notion of soft landing. For me, we are still in this process. We are in a soft landing. We have the bad news that is arriving, the market which is in the process of absorbing this bad news, which are the fact that the economy is resilient. Good news is bad news. We are really in this process. So we are in the process of accepting this. And for me, it will really be, are the geopolitical tensions going to be capable of being regulated to be able to have an oil which will remain below 93 or even stagnate between 70 and 93, to be able to have a breather and have an inflation here which will decrease and really make this pivot of the Fed running in 2024 to have a American breathing. And that's going to be really important. And what's going to be decisive is going to be two things. It's going to be here, these rates, I think that at a given moment, we are no longer in a catching up, which is in the process of being done, and we will breathe. That is to say, for me, we are going to go into something that will be done like this, and then we will return to something that will be a form of breathing. So there we are more in this form of classic acceleration, and we will have at the moment when we see the crossings of the lines there, information which will say, be careful, we are in recession. And that also corresponds to what we are seeing, which is the difference between 30-year vouchers and 2-year vouchers, which is the remuneration of both. So normally we are supposed to have a curve which is positive when we take the differential of the two, because we are more paid at 30 years old, because that we must in fact hold the treasure bonds for 30 years before recovering the ticket. And compared to the 2 years, and there we are already in the process of returning to positive. So that implies that we are in the process of regulating ourselves on this inverted curve, which everyone talks about more regularly and generally. When we return to zero on the 30 years, and especially on the 10 years, we will look at the curve. This is where we start to enter into recession. And there we see that the 30 years have passed, and the 10 years we see that it is accelerating. We can already see the week last big acceleration this week. We are in the process of validating. I think that next week or the week after, we will return to the positive, and there we will potentially have the implementation of recession communications, and therefore behind us we will find ourselves on an SPF 500, which will be to press in. Are we going to hold the 4,100? Are we going to look lower? Are we going to seek, why not, a level of liquidity here at 2.618 with the 3,800? I didn't think about it at the beginning for several reasons, because technically at the BTC level, I'm going to show you, we had targets which were fixed with a coherent correlation. Here we are in a correlation which is not coherent. I'm going to show you explain why. But so, for me, the 4,100 are the first target, second target, 3,800. And I think that 3,800 corresponds to a price which will not be so high in terms of BTC. We will immediately look together why. So at the level of the targets, we will move immediately to the level of the CME BTC. We see that we had a week which was relatively violent on the rise, whereas we are really limited in the reverse. We find ourselves in a BTC which greatly outperforms the SP 500, and in which we have a surge while we have an SP 500, which is in the process of stalling, a NASDAQ which is in the process of stalling, while we have an economy American which is holding, but which is holding because the rates have not yet taken place. That is to say, when we actually look at the debt renewal rate, we see that this is not yet the case. That is to say that people have gotten into debt with rates at 1% and they are not going to change right away. So obviously we have a distillation which is much slower than expected. I thought that we were in a distillation which was much more aggressive, except that here we really had the latest figures which fell on what we call rollovers, which are the turnover of effective debts, and we see that it is relatively weak. There is some, but it is relatively weak, and I think that this is also what will play a role in which we have an economy which is resilient thanks to that, and which makes it possible to absorb this increase in rates. In short, to come back to BTC, for me we really have a big target which is the rupture of the 25,000 to seek, retest the 22,000, 21,000, and the 19,000. Very clearly when we have broken the 25,000, we are going to have people who are going to say, oh, that's good, we are back to 10,000. There we are going to have the 10,000, 12,000 who are going to come back to the top for me. I2, reload zones, it's a 21,000 up to 19,000, and second 17,000 up. 16,000, in which we retest potential here from this low there. And again, for me, the probability is relatively low, even if we have a SPY 500 which stalls, and which will fetch 3,800, even which will fetch potentially lower. Okay, so for me here, 3,800, we retest from the bottom. We would be in the targets of 20,000, and if ever we go to look lower, and we will look for prices which are much lower at 3,200, and there it would rather be a form hard landing, which would be really very violent in terms of the American economy. And therefore that means a tightening of the war, etc., etc. So there we enter into a setup which is totally different. Well, at that moment, it would be 15,000 BTC, okay, because we have a decorrelation which is very strong. And when we look at this decorrelation index, therefore which is BTC divided by SPX, therefore which is the SP 500, we see this impulsive candle in which we are starting to rise again. We see that we have more only a form of correlation. If we were in a one-for-one correlation, we would have something that is flat. Okay, if we have a price that is going up, that means that we have an outperformance of the BTC, that we have a price that is going down, that is going down. That is to say that we have an underperformance of the BTC. Well, we see that we have had a form of resilience in BTC already for some time. And when we look at this week, we really see something which is very marked, which was already marked before, and which continues to be marked there. So for me, we are really in a BTC, a crypto that is oriented towards endogenous elements. And we have more and more news that we find ourselves in a BTC which will have ETF validation. Is it going to be right away? I do not think so. Again, for the month of 2024, I may be surprised. For me, it remains my hypothesis, or even potentially March 2024. On this, but we still have news, that BlackRock and the SEC are working together to be able to do it. There is BlackRock, which is reproposing new documents. We have Fidelity, which is reproposing new documents. We still have elements which are starting to tell us, okay, it will be validated, the question will be when. So obviously we have here a form of pricing which is in the process of being to do, and we must ask ourselves the question, are we not in a process of kissing the rumor, selling the news, which is in the process of being made? That's the big question I'm telling myself. Wouldn't we go looking? Why not really break out the range that we have there, because we have a big range which has been there for a certain time, break out this part with precisely a preparation of this news, the news which gives hop, then we have a break, agreement? See, even the news, we have the breakout before the implementation of the news. A small rebound and then we sink. We will retest the buy. We will continue in a form of range in which we have a transfer liquidity. For what? Because yes, we are waiting for endogenous elements, but that does not prevent us from having the liquidity. And you need liquidity at some point. ETFs are good. They open up liquidity. But do people have any interest in looking for these elements? Do they have an interest in exposing themselves to risk to obtain returns? Because that's what ETFs are. It's generally an opening to stronger institutional players, to stronger liquidity to enter on the market. But is there an interest in going for ultra-risky assets? And on that, I'm going to share with you this curve, which is really impressive, which is the representation of the yielding, therefore, of the interest rate that we can be found on the SPF 500 versus the rates that we have at the level of the US bands. We see that we are at 0, which means that I take the rate that the SPF 500 brings me, from which I subtract the rate that I can have by holding American Treasury bonds, and I am to 0. So that means that I have no risk premium. Implied, if I have to translate it differently, I have no interest in going for assets like the SP 500 or riskier assets because I am very well paid on US bonds, which is the least risky asset in the world. Okay, so at what point am I going to go for SP 500 now, while behind I have a possibility of having a return which is the same without any risk of a discount that I could have, to know that I am not the only one to have this vision to say to himself that we are going to look lower, so we have no incentive to inject liquidity into risky assets, the SP 500, the BTC, because for the moment we are in moments when we are already perhaps overvalued on both, and in which we have no interest in seeking yield, because we already have it through good American treasuries. And that is why yielding is increasing, and I think that that is where we will have a change which will take place at the moment when we will have this implementation of falling rates here, an increase in the TTL where we will break this level here, the 92. There we will have a very good signal. We will really have communication. It's the recession, we're in the poop, and it's where we will find ourselves in a process where we will say, okay, well, there we have a rotation of assets which will take place because we will have a return of interest to go on risk, because precisely we will have a rate which will be interesting, because we will have a SP 500 which will be underrated, in which we will have a SP 500 which will be more interesting, a BTC which will potentially be around 20,000, which will find an interest for purchases, and in which we will find an interest-effective liquidity. So for me, we are in this process, and that is why it reinforces my bias immediately. I am just telling myself that this form of resilience that we have from the PTC is linked to the notion of news. I just ask myself the question, is it the principle of buy the rumor, sell the news, or are we really in long-term resilience? And at that moment, the zone of 15,000 is already starting to become complicated to say, okay, am I going to recharge at 15,000? All right? Because if we have a resilience that is really established like this, we are seeing that it is not a form of pure event that we will be able to have precisely with the establishment of ETFs. And therefore, at that point, we would have a bearish breakout which would be much more violent, a real return of the entanglement between the gods. And so, my question is, are the 15,000 still possible? Really? Is 15,000 still possible? Even with an SPF 500 that affects 3,800, 3,500? Will a BTC at 15,000, without endogenous elements specific to crypto, will we see the 15,000 again? And that's really the question we need to ask ourselves. That's why I'm making this video for you, and why I'm making the Saturday videos for you. Because that's where we ask ourselves the questions really in relation to the evolution of the market, because each time our strategy must adapt by relation to new information, to the reaction that we can have, because the Fed only reacts to the elements that it sees. And so we cannot anticipate what the Fed does, because the Fed does not know what it is doing. She reacts to what she sees, and she is surprised, as they said. Seeing her in a speech, I go back to the beginning of this video, move this speech forward. It clearly shows the extent to which we cannot anticipate what is going to happen. We can just plan the different possibilities and get set up. And we will also have to foresee other possibilities, which are the endogenous elements of crypto. Not necessarily positive, and in particular what is happening at the level of Binance. And that's tomorrow's video, 8:30. Don't forget, we're going to come back to endogenous elements like Binance, like Bybit. What exactly happens if we ever have sex which is in progress to collapse? And how we can anticipate, how we can protect ourselves, which sexes can be at fault, how we can protect ourselves from these things, and I will explain to you my position, and even how I protected myself from all these elements. It's tomorrow at 8:30, and I wish you a very happy Saturday.